Good morning, everyone. Welcome to this rundown for global stocks for the 13th of December. And the American market and European markets finished on a very poor note on Friday night, and there was some significant support levels broken. So it was certainly quite a negative session, and we certainly shouldn't just ignore it. That's for sure. So I want to explore uh, what's caused it, and is it likely to be an impact that's going to get bigger, and in particular, what is 2016 likely to look like. So let's get into it, and I just want to cover the general backdrop as an overview. And I think the point that I've been making to members of specialist share education for the last couple of weeks, and certainly on several occasions last week, is that there is a new dimension that has emerged in global financial markets, and it relates to the plunging oil price and the likelihood that we're going to see plenty of bankruptcies in the smaller end of the energy market, particularly in the American shale oil producers, and that can lead to default on corporate bonds in the energy sector. Now, this is a very specific risk, and you might think, well, if a few energy companies go bust and their bonds become worthless, they default on their bonds, then so what? And that may end up being the case, because I think it's an absolute given that there certainly will be bankruptcies in this sector. And there are already some companies that are going to the wall already. But the real risk, and this is hence I think the big selling on Friday night, is that the markets always starts to worry about what might be rather than necessarily having the evidence to back it up. And the concern is that there could be a contagion effect that may cause a lot of other disruption. So in other words, losses in the high yield or so-called junk bond end of the market, which is tending to be fairly illiquid, could cause institutions to have to sell other higher quality bonds to cover those losses and to cover the liquidity. And if that occurs, then it could spread far more widely into the wider corporate bond market, and that would not be at all helpful for equities. Now, I'm not saying that that's going to happen, but that is certainly what the market is starting to worry about, and the signs have been there now for several days that was going to be the case. So market sentiment has moved very, very quickly to one of risk aversion. It's really quite stark, the change in just a few weeks, and hence we saw the start of a bit of selling early in the week. I think the S&P index has now gapped lower on the open on 4 successive sessions. So there's definitely a movement out of the equities market in the very short term. The question is it going to continue? Because we've seen this so many times over the last 4 or 5 years, and they've all come to nothing, and this one may come to nothing as well. But we can't afford to just ignore them. So the question is whether the selling in the high yield energy bond market, which is already occurring, so there's no question that people are selling off bonds in that part of the market, will that cause contagion into other parts of the bond market? And then, of course, if that occurs, then it's pretty much a given that the equities market is going to sell off as well. Now, the difficulty with knowing how to play this is that we're talking here about fear, we're talking about perception of the future rather than fact. And fear is impossible to predict. So, we can't know with any degree of certainty or confidence about how this is going to play out. All we can do is just anticipate what a good, sensible, prudent action might be to take at this point in time, given the doubts. Now, there's no question that volatility can be scary, but also when volatility picks up significantly and prices plunge and people panic, this is when the very best opportunities arise. So, just whatever unfolds over the next few weeks or few months, always remember that. Have some cash and be prepared to utilize that cash when high quality stocks have been sold off to unreasonable levels, because the likelihood of those stocks bouncing back is incredibly high, and the gains can be significant and they can come very, very quickly. So just keeping it all in perspective, there's a lot of people that are selling the banks, worrying about the fact that the banks might be exposed to these energy loans that could go bad. The reality is, amongst the major banks, and I think Wells Fargo might have the largest exposure of the American major banks to the energy sector, and their exposure is 2% of their total loan book. So 2% is the maximum, and all the others are less. So there's no way that this is going to explode into some massive problem like we saw in the GFC, because there's just not enough exposure. Banks are far better set up financially now. Their balance sheets are much stronger than they were in 2008. So, that's just not going to happen. Some junk bond investors are going to be very, very badly burnt, but look, frankly, they deserve to, because if you accept a really low return on your money for a high risk investment, which is what people have been doing in that sector of the market now for years, then you deserve to cop a hiding every now and again, because it's just not a smart play at all. If you're going to take a high amount of risk, then you want a high amount of return. And that's just fundamental economics and finance. So I don't believe there'll be a lasting impact on quality equities as long as you've bought them at a good value price. History shows they always bounce back from any kind of market-driven fear, and if you've got some cash, it's generally a great opportunity to be buying. So overall, investor sentiment has definitely shifted to caution over optimism. There's no question about that. And this is normal when markets are faced with uncertainty, as we have now. There's an uncertainty over the Fed and interest rates. There's uncertainty over China. There's now uncertainty over the bond market. There's all sorts of uncertainties, and so it's quite normal for investors' sentiment to swing to a more cautious stance. So that's the backdrop. Turning now to the American market, the S&P was 500 was down by a pretty big 79 points for the week. That's a big move, particularly in what's been really a range-bound market for all of 2015. The peak to trough difference is about 14%, which is pretty narrow for across an entire year. So that's why it's been quite difficult this year to make progress, because the market just hasn't gone anywhere, and most of the major quality stocks have just been tracking sideways. And the S&P index has crossed its 50-day moving average on 38 occasions, which is, it's just market noise. You can't trade that sort of market. There's no trends when you're just back and forwards across the 50-day moving average. It's very, very tough to make headway in that sort of market conditions. And to be honest, it shouldn't have been unexpected, given that we had a 30% gain in the S&P in 2013, and that was followed by an 11% gain in 2014. So the fact that the market is now actually a little bit behind in 2015 is, when you stand back and you look at it over a multi-year time frame, is pretty normal. The market's just got to take a breather and catch up, and that's what's happened this year. And that's why I've stressed for the last several years, but particularly this year, that stock picking around quality stocks and value is just so vital. Going into index funds, trying to manage your risk by diversification is just, I think, a very, very limiting strategy. So definitely about stock picking around quality and value. Just looking at the technicals, and we'll get to the charts in just a minute. The key 2020 support level was easily broken on Friday night. The market didn't even pause for an instant at that key support level. It just went straight through it and finished on its lows. That has to bring the next couple of support levels into play at 1993 and 1964. So, we could see another 60 to 80 points down in the American market yet over the next few days. That's entirely possible. Looking ahead to 2016, longer term, the market will always come back and revolve around the key principles of finance, and that's about stock earnings and interest rates. That will determine where stocks go in 2016. But you have to expect higher volatility. So I think what we're seeing now is not going to change what we've seen since the middle of the year, with some substantial moves up and down, possibly without any net trend. I think we're just going to see more of that in 2016. So let's get to the charts. And I just want to start with the VIX index first, because this is really the key at the moment. So we look at this most weeks, you can see that we've again spiked up. And if you look at the concentration of these spikes, this was a pretty big spike in 2010, again in 2011, and then we went into a very quiet period, 2012 through to 2014, where the VIX stayed below 20 virtually the entire time. We had one little blip in October of 2014, another little blip in the start of January of this year, and then it immediately sunk back down again. But then we had the August mini flash crash, settled back down remarkably quickly, but it's off again. And so there's definitely some fear has come back into the market quite quickly, and that was somewhat unexpected, I must say. And you can see just how much fear came into the market before the Friday session. So from the close, the VIX closed on Thursday night at 19.5, which is a little bit elevated, but not too bad. But then it just opened at over 22 on Friday night. So there was a big scramble for the exits and a big scramble for put protection on Friday. Turning now to, so let's look at the S&P. You can see the sharp move on Friday night. Here was the area that I would have expected support. We found some support at 20.45, and we did see that. You can see here on Wednesday, we bounced off it. Thursday, we held it. And then Friday, that level gave way. And we also broke this key support here of 2020, which was the lows of November, but also the first Fibonacci retracement level of this whole run, the last run to the upside. So key level, market went straight through it without stopping. 1993 comes into play, and then 1964. And you'd be a brave person to say that the market won't at least test the 50% level. So I think the overwhelming odds are that we'll see some more downside in the American market in the coming days. There might be a little bit of a bounce where short-term oversold at the moment, but we'll just have to see where that goes. Now, just turning to some of the other markets in America, the Nasdaq index wasn't a massive decline, but it certainly gapped lower and closed on its lows. So that's not a particularly exciting pattern. Importantly, the small caps. If we look at the small cap index, this is on a weekly chart. This is the Russell 2000. You can see it was quite a decent old fall on across the week last week. So that's just the situation for the American market. We'll come back to that at the end of this video. The Aussie dollar working back towards the bottom of the trading range. I've talked about this last week. It was really a very crowded trade and was ripe for some profit taking. The index bounced, but it's heading back down again now, as indeed it should. We saw oil off another $5 or $6 through the week. We saw iron ore down further. Eventually, just the weight of poor commodity prices had to have an impact on the Australian dollar. Aussie stocks, the ASX index was down by 120 on the week, but you're going to see more selling on Monday for sure. There's a key level at 49.50, and I would expect that to be tested on Monday. And if that breaks, then we could see quite a bit of technical selling come into the Australian market via the banks in particular, I would expect. So there's very little in the way of trends at the moment in the Australian market. It's just hard work. There are some very specific stocks that are trending very strongly. They tend to be in very isolated niche markets. and the market tends to jump all over them very quickly, and they get very, very quickly pushed to just excessive valuations. So you've got to be really careful in that sector of the market as well, that you're not buying into something that's been rising in a parabolic sort of fashion. The best value for risk opportunities exist outside the top 50. And these sort of corrections will bring some terrific stocks back into calculation, but they're not the top 50 stocks. They will reside in the 100 to 300, top 100 to 300 bracket. And, they provide some terrific long-term growth opportunities and some good value. But again, it's very much a stock picker's market. So just looking at the Australian dollar, you can see this lengthy consolidation that we've got after the big decline that really started. We're up around the 95 mark last time we consolidated. That was in 2014. We got a sharp decline down to this lower level, and we're just in this range now down here and heading back towards the bottom, as indeed it should do. The ASX 200, you can see the support at 49.50, which was basically the August and September lows, and you'd have to think that's very much under threat on Monday or Tuesday of next week. So be pretty careful in the Australian market. Just while I'm here, I'll look at gold. There's gold on a weekly chart. Despite the US dollar moving a little bit lower, and despite the fear on Friday night, gold really failed to respond, which is interesting. And there it is on a daily chart. So there's still nothing yet in the gold area to indicate that we're at the start of a new bull market. There was quite a positive day the previous Friday, but no follow through at all. And if you look at the American dollar, you can see that it came off from around 100, the US dollar index, and we finished the week down at 97.5. So off by 2.5%, yet that had no impact on gold at all. So I think that tells you something about the state of the gold market at the moment. So gold lower by $12 for the week, and disappointing. It was the perfect environment for gold to perhaps spike by $30 or $40, but it didn't do it. And stocks not doing anything either. So we're not seeing any, gold stocks normally lead in both directions. They're not moving to the upside at the moment, so they're not providing a positive lead. Copper was higher at $2.13, and that really was just pretty much currency effect. It was 209 the previous week, so copper just moved up a little bit in conjunction with the US dollar falling. But crude oil really got smacked hard from $40 down to 35. And, it wasn't that long ago that crude oil was trading above $100, and people were talking about how it would never fall much below that. And now we're down at 35, and with the possibility of further declines. And during the last week or two since the OPEC had their meeting, they've actually increased production into what is a declining price market. So, that's what's doing it. Spot copper, as you can see there, moved up just a little bit. So just to wrap it up, the overall strategic approach, I think some caution is warranted. There's no question about that. The S&P index broke through some key support levels, and it did it easily on Friday night. It was a big move. The overwhelming odds are that we'll get some more downside yet. But there are really no sell signals, so I wouldn't panic yet. But there is substance to this. There is substance to concern over the high yield junk bond corporate market. So in the past we've seen some significant market moves really over some irrational fear. There is some substance to this, but nobody can predict how it's going to play out. So some caution warranted, but it's yellow lights at the moment, not red lights. We often see a 2 to 4% pullback in December, so we're seeing that at the moment. So it's not abnormal, but we wouldn't want to see too much more. I certainly I'd like to see the 50% retracement level at 1993 hold. So there's still a good cause or a good case for optimism, particularly in the American market. So we can't just throw everything out that I've talked about all year. A lot of those things are still in place in the American economy and in the American corporate situation and earnings situation. So still a case for optimism. People are asking me whether we should be starting to buy into energy. Look, I think only if you had an extremely strong stomach and a very long-term view. I think there'll definitely be a day to buy energy stocks, high-quality energy stocks, but we're not there yet because I can't say that oil's not going to go down into the $20 area. And if that were to occur, then you can guarantee there's going to be more downside for energy stocks. The reality is that the demand for oil is still rising, but it's going to require the price being low enough for long enough to not just force companies just to temporarily block in production. It's got to actually cause bankruptcy. It's got to force these stocks out of the market so that when the oil price goes back up again, that they just don't immediately open the taps up again. So that's what's required. It needs a substantial level of bankruptcy to force those producers out of the market. So that's the rundown for this week. A bit lengthy, but look, it's important to get the backdrop right and to get your strategy set right. Members are getting this information every day from me, so they know what to expect. If you're not a member of Specialist Share Education, this is a really important time to, if you're not really sure what you're doing and you're not clear what you're doing, then you can not only protect your capital, which is important, but there's going to be some terrific opportunities arise as well. So this is a double-edged sword. If you can position yourself the right way, you can protect your capital and you can make some good gains as well. So there's my contact details for anyone that would like to get in touch with me who's not a member. That's it for this week. Cheers.